What's going on, traders? Welcome to the Market Primer for January 31st, 2022. The markets finished green on the week. That was some very wild price action. That was a stunning reversal that we saw on, every single day. The levels on an intraday basis were so clean, and it was very interesting where we had so much intraday volatility, yet on a close-to-close basis, it was actually much more compressed than what we saw. And just the travel and the energy required to make the market move like that, it depletes a lot of financial capital. It depletes a lot of psychological capital as well. I mean, you go through this meat grinder, and let's just say you just didn't have a good week and you just bought and you got stopped out and got stopped out and so on. And you're saying by this time, either I'm out of buying power or just screw it. I'm not going to wait for that. I'll just wait for lower levels. So I do believe that we had a variation of that happen across the board last week. We finally saw the generals get taken out. Apple had a decent sell-off. It had really nice earnings and so on, but there was a good give back right there. I mean, Amazon's getting absolutely crushed. Tesla, it had its earnings event, and it completely fell out of bed on Monday, and then after its earnings event on Thursday. I'm sure I haven't looked at Google in a bit, but yeah, we have seen good-sized corrections in these mega-cap tech stocks that were propping up the market while the rest of the market went behind the woodshed and got shot, right? So I think that right now we are very close to a local bottom in the markets. Now, does that mean that we're going to have this be the bottom for the year? You don't have that kind of information, and I would never say that. That's not my time frame. I do want to point out that if we go and we look at how markets have traded during volatile events, during modern markets, so after the great financial crisis, but before COVID, how we trade after volatile events is that there is a tendency to retest those levels. The odd man out, and we're just looking right now 2014 to 2020. So this is about a 6-year window. Odd man out is Oct 2014, which was a V bottom, and that was a miniature pandemic in Africa with the Ebola crisis. Okay, and then we just stepped through these. Oct 2015 was that Chinese currency surprise adjustment, and we went into a very volatile trading range with a retest of that week's open. And then 2016, all right, and this was the taper tantrum. We basically put in a double bottom right there. If we look at the Volpocalypse in 2018, there was a retest of that low after a significant rally. And then we can look at the late 2018 price action where we had, before it completely fell out of bed and crashed, we had something like a 3-month trading range. Okay, so I think it is reasonable to suggest, first off, that the market has established a trading range pretty close to where we are, and it's probably going to be the low, but we can work inside of a trading range longer than what people expect, right? If everyone on the bear side got hedged up, super hedged up this week, because we see evidence of that in the options markets, then it's going to be very difficult to see price movement to the downside. You also have a lot of people who are dying for liquidations at higher prices, not necessarily in the spiders or in the Qs, in the NASDAQ 100, but in a lot of these tech stocks that have been absolutely obliterated. Okay, so there is still plenty of supply out there to cap prices somewhere. And so it is okay to suggest that this is probably the local bottom, right? I think we saw enough deleveraging, a lot of hedging, enough of a flush to say, that was probably it. But you don't have to go out and say, oh, that means new highs by May, and we're just going on this monster bull market run while the Federal Reserve is still hiking rates and all this other stuff. That's not a reasonable proposition either. So it's not a dash or crash, right? We're probably going to have a high volatility trading range, and I'm a big fan of those anyways, so maybe I'm a little biased. on our levels inside of our roadmap. And I do want to point out that these lines and these indicators, I don't think I've moved any of them. So these levels that we looked at last week are also the levels we're looking at this week. So we did have a local level right here, this LVN, along with an internal pivot level that I thought, last week we could find something, if we just saw a little bit of a gap down right here, maybe buyers would bring it in and so on. And then Monday hits, of course, best intentions aside, things change very quickly in this market. So we did see a gap down, and in terms of the exact low for the S&P, I don't really have anything drawn right there. But I do want to point out the wicks that were put in the 4 days after that, and how any sort of responsive buying pressure all came in from these levels right here, and that's a big LVN. Okay, so I think that we did see a liquidity break on Monday. It did move further and faster than what everyone else is expecting, right? I don't think that there was some sort of magical level on the S&P that you could say, oh, that was such an obvious level right there, and you just buy it and go from there. But after we saw that drastic instability come in a little bit, we did find buyers showing up right here. So that's a pretty good reference point to work with. Not necessarily the absolute low right here, but saying, hey, this is probably where we found buyers. And we found a lot of response into that. Okay, so it's probably the low. The question is now how high? There are absolutely some option-related mechanics that will come into play here very soon. We know about gamma squeezes, and everyone should know about them, especially after 2021, because AMC and GameStop were gamma squeezes. We also have things that are called Vanna Squeezes, where basically if you buy a put, the market maker takes the other side of that trade, and then that means they're short vol, but they have to short stock to balance, and then if volatility goes down, then they have to buy more stock to rebalance or buy back that stock. So that can provide absolutely fuel to the upside in that particular case. So with that said, the market can rally further and faster than what a lot of people think. The textbook setup would be to say, hey, we've got this level right here. We've got that huge LVN coming into play. We've got the anchored volume weighted average price from all-time highs. And so this appears to be a very good area to consider shorting. My contention here is that it's a tough trade, because the question is, okay, where are you going to stop out, right? So getting stopped out, my question is, where is everyone going to get stopped out? And that's the level I want to short, okay? Because right now, buying puts is really stinking expensive. Shorting the market is, if you're just going straight Delta 1 with short futures or short stock, that's very risky, because even if you do want to consider this a bear markets, the rallies are just as aggressive as the sell-offs. Okay, so you should expect some of this energy to rebound the same way that we saw with the sell-off. So with this, I think a better level to play off of is going to be close to this LVN right here. And that, if you can see it on this right-hand chart right here, that corresponds with this high. Okay. Now, I've talked about this already, where we could set up some kind of a head and shoulders pattern that truncates, and then we find buyers coming in, and that would just upset everyone, which makes it very likely. So we'll keep an eye out on that pattern. But this would be a much more easy level to manage against if you do want to go short in the markets. And then you've got some other levels, but the problem is, if you just keep chasing up, you're going to end up with a market at 464 and you're out of buying power again. All right, so just keep that in mind. There are good spots to short this market, I do think. I think a high volatility range is still the likeliest bet. Let's hop over to the Qs really quick. And we did see some levels come into play, very similar to the S&P, where we get this nasty liquidation break right here. But after that, we kind of see some levels start coming into play off of that prior resistance, now potential support, the swing VWAP from this level right here back in September. All right, so even though we are seeing moves underneath it, we are seeing responses back above it. So it is a level that I still think is quite valid in the markets. We did have this little baby LVN right here, and then this one right here. You know, if you wanted to look at this in complete hindsight, I'm sure you could find some level. But as it stands right now, looking off of and keying off of 342 right here is going to be very valid. And so if we close underneath it, that means things have gone much worse in the market, and you can absolutely see that cascade to the downside. Okay. The cues, remember, 50% of the weighting is in 6 stocks: Microsoft, Amazon, Google, Apple, Facebook, and Tesla. I think I caught them all. They're not Pokemon though. So if you look at some of the movement we saw, especially on Friday, it was due to Apple earnings. All right. So when those earnings come out, they will have an outsized effect on the NASDAQ on its own, which is why you could see skip risk and gap risk and things like that. So first level to watch. And if you want to be bearish on this market, if we don't even find enough strength to take out 357 quarter and we start rolling over, that's a sign. All right. And that one you may want to play against that level if you are bared up and expecting significant downside in the short term. Okay. If that doesn't happen, then you may need to pull back and say, let me reassess or at least get some better timing on this. The next level above that is going to be swing a view up from right here, swing a view up from right here, and very large volume shelf LVN coming into play. So that's also the 20 EMA. So this area right here is something of note. Just like the S&P, I think it's too obvious of a level, and you may see squeezes above it. And once you see evidence of people getting stopped out from that very obvious short, that's the place to start looking at layering on some risk. Okay, so I'd be looking at, and we can just throw these on here really quick, against these swing lows right here, and the LVN, let me see if I can just draw it right there. Okay, so, you know, obvious short level right here. What happens? The market accepts it, and then we break above it and get all these people who shorted right here stopping out. That's going to be a better place to put on some short exposure. Okay. Yeah, and that's basically it. You know, just high volatility kind of trading action until proven otherwise. You know, obviously things can change. We can see a resumption of the overall bull trend, or the whole thing can fall apart and see under Western capitalism. But in terms of probabilities and odds and where you want to speculate, you know, that's a reasonable thesis to have right now. One more in the indices, and that's IWM, and this really was a work of art. Okay, it did make a lower low while the rest of the markets were making higher lows, and that's probably because the Russell sucks, right? We haven't seen it in a good bull trend. We could make the case that the bear market for the Russell started February of last year, and we just went sideways, big failed breakout, swift move to the downside, bounce coming up into that swing AVWAP and this volume shelf right here, and then the whole thing completely falls apart, right? We see a bounce right here. It takes 4 days to get back to it, and then we completely roll over. So it's not unreasonable to say, hey, you know what? Maybe you just need one more flush. And so these double lines, I'm pretty sure I had, I'm pretty sure I had them on from last week, and that's just the swing lows from right here, as well as sort of a local LVN. And so that's where the market hit on Monday. And then we come back, we see this bounce, look at where the bounce happened, see the last LVN before this massive range. That's where it was, right? So we get that sell-off on Friday, and it comes back down to the swing AVWAP from March 2020, the absolute lows of the market from the pandemic crash, and that is where buyers step in aggressively, and we finish at the highs. All right, very high odds of a bounce right now. Okay, now I'm not saying all-time highs anytime soon. Again, easiest setup is to say, hey, high volatility trading range until the Fed finally gets all of their signaling out, things like that. So you do have a very obvious reshort level right here. Okay, just like the S&P and the NASDAQ, that's a very obvious level. Maybe wait for those shorts to get blown out, and then you've got a really good opportunity right there to maybe buy some puts or short stock or do some sort of leveraged play. Okay. A couple other things in the volatility markets. If you look at the VIVX, and this is one of the reasons I'm fairly confident that this was a local low in equities, is that we did see the demand for VIX options. I mean, it spiked up to the 170s. It's the highest reading we've had in a while. And then we just saw it trade lower and lower, meaning that after Monday's capitulative low, the demand for hedging just continued to drop off a cliff. Nobody wanted to go buy VIX calls when the VIX was trading in the 30s, right? Because the move has already happened. If this continues to unwind, it will, just by the way option markets work right now, it will provide fuel to the fire for equities. Okay, and that's just, there's some options voodoo there. I've discussed it in detail before, and we'll just leave it at that. Very similar thing in the VIX. The VIX did trade up to 38.39 on Monday, and then a continued pressure right here. It's not that anyone's aggressively shorting, it's just no one's buying. If everyone and their mother is hedged to the teeth, then the market can't sell off. Because when the market does sell off, the people who bought hedges say, oh, cool, I'm going to unload some of my hedges now. And then that puts a floor in the market. Because the market makers have to take the other side, and there's all sorts of stuff that happens. But that is one of the reasons why we look for market bottoms after the VIX is spiked. Because the capitulative demand for hedging has increased so much that you can't find any new sellers at the margins because none exist in the short term. So if this continues to unwind, it should be something similar to what we had in, a little bit of a pullback in December. And you look at that distance, and then you look at the most recent distance between some of these spikes, and you're going to see it's at least a month before we get any more scaries again, right? So it's 20 trading days to sort of reset the market, let some of these hedges burn off. By that time, the S&P has already seen a nasty rally to the upside, okay? So that's how I'm positioned. That's how, our clients at PVA are positioned as well. We did put on some new long positions all throughout the past week. So if you do want access to that, as well as to see how we use our volume roadmap, there is a link below this video that will take you to a free training that shows everything we just talked about in a lot more detail and the profit potential you can have. That's all I got for now. Thank you all so much for watching. I'll see you later. Take care.